Good afternoon, everyone, or morning, depending on where you are today. And thank you for joining session 2 today of Cherry Bekaert's 2022 Tax Credits and Incentives virtual conference. This one entitled Legislative Updates Impacting C&I Credits and Incentives. If you're now just tuning in, my name is Marty Kerman, and I lead Cherry Bekaert's Tax Credits and Incentives Advisory Group. And it's great to see many of you sign back up for the second round today. So we really appreciate that. We put a lot of time and effort into this, and we hope you enjoy it. We have a variety of presentations planned, and we will be offering up to 1 hour of CPE per session for a total of 4 hours if you attend all 4 sessions. Again, we're focused overall today on an agenda related to helping companies take advantage of federal and state incentives to generate funds for capital investments, to minimize tax liabilities, and to incentivize behaviors that the government is incentivizing. And we hope you can also join the remaining sessions. Before we begin, here's some items to note. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. And if you don't receive yours after 10 days, please email cbhlearning@cbh.com. A recorded version of the webinar will be available in about 1 week and will be sent via email and posted to our website as well. If you have questions during the webinar, please type them into the Q&A window located in your control panel. And just a short note, a survey will be posted at the conclusion of the webinar. We absolutely value your feedback and ask that you take part. And with that, I want to introduce you to my friends and my partners, Ron Wainwright and Dan Nettle, who really co-lead with me the Tax Credits and Incentives Advisory Group, where our focus is identifying and documenting incentives. We're a national group comprised of up to 50 plus people. So again, just want to thank Dan and Ron for their participation today. And with that, I will hand it over to them. One more thing before we get there. I'll go through the table of contents. Okay. We're going to focus at the beginning here from a legislative, and it's not just legislative, it's procedural as well. We're going to focus on R&D. We just had a prior session where we dealt a bit on R&D from the perspective of the IRS and an outside practitioner. I think we're going to give a little bit of our perspective here as well. I'm going to talk a bit after that about the employee retention credit, clearly an area where a lot of people are interested, and talk about the information document request that the IRS has issued specific to that and how people's deliverables may want to make sure that they're answering these questions. Ron is going to talk a lot about clean energy tax proposals. We're going to talk about the infrastructure bill and expected upcoming legislative updates impacting C&I. So for the most part, this is going to be Dan and Ron's show. I'll be adding in a little color as we go through. But with that, take it away, Dan.
Thank you. Appreciate it, Marty. So we're kicking it off with a polling question. Polling question 1. And again, just to reiterate what Marty said, there will be 4 polling questions. You have to answer 3 out of the 4 to get credit. Polling question 1, how under the Tax Cuts Job Act of 2017 were the treatment of R&D expenses changed? Repealed, requiring capitalization of R&D expenses with no amortization, enhanced by allowing taxpayers to deduct 150% of the R&D expenses, or on January 1st, 2022, R&D capitalized, must be capitalized and amortized, or none of the above. So we'll give you a minute or so to answer those. Make sure everyone gets a chance to do that so you can get the CPE. All right, it looks like 158. We'll give a little bit more time. 86% have participated. And we'll, on a couple of these polling questions, we kind of want to get a baseline of your understanding of the areas before we jumped into the slides. So thanks, everyone. So the first thing we're covering today, as Marty showed on the agenda, is Section 174. For most of any of you who are involved in R&D, take R&D credit. You'll know this is the elephant in the room for the longest period of time over the last couple of years, many people thought that this guidance would go away. Although, as any of you know, when something generates this much revenue, it's hard for politicians to let go of it. So we're covering it today because unless it's overturned, this is going to be the rule change that we live with. And just to remind everyone, for domestic R&D, we're moving from immediate expensing to 5-year capitalization, amortization, and for foreign R&D, 15 years. Again, just to reiterate, there is the potential, there is bipartisan support for this to be postponed or changed. And we'll see whether or not there's the willingness, bipartisan support. Democrats are reluctant to use this without the resolution on child tax credit. So we're kind of in a wait and see pattern, all hopeful, but we all need to prepare for this as the policy going forward. So just revisiting what this means, what's historically how it's been treated. Historically, a lot of taxpayers didn't worry about 174 and may have treated a lot of the costs interchangeably with 162, but now with this distinction and treatment, that can't be the approach going forward. Taxpayers have to be cognizant and look at and scrub the cost relating to 174. Many taxpayers historically have leaned on their 41 credit to be the basis for 174. And again, not really focused because of the similar treatment of ordinary and necessary under 162. However, there are a lot of distinctions between 174 and 41. All of the following items on the right, all those bullets have to be adjusted from 41 and added back to get to 174. So the wages are gross wages, not just box 1 W2, all contract research costs, not the haircut that's applied under 41. And then a lot of the facility costs, the cost of depreciation, obtaining a patent, and offshore R&D. So those are all things that taxpayers are now going to have to go back and scrub. In addition, the amortization of R&D will affect the creation of NOLs. So one more item that you'll have to consider. So this slide, we kind of just walk through and set up a basic example of the impact of 174. Not that complicated, but if you assume in 2022, you incurred $1 million of R&D. You have a 5-year, as we said, for domestic R&D. You have a 50% mid-year convention. That's a 90% detriment to your deduction. So this is it's very significant, and it's going to impact a lot of funding and other things that people have to consider for the material impact this is going to have on the return. In addition, it isn't just isolated to the deduction of the 174. It has carryover effects within FDII and GILTI on your foreign tax credits, state and local impact, and then interest deduction limitations. So it's far-reaching, and modeling this now is a good idea to see the impact and think through all of the implications. So next, I'll turn it over to Ron to talk a little bit about the R&D Credit Coalition and insights from that coalition.
Thanks, Dan. So those of you who may be, and I hope are, one, claiming the credit, and then active in the R&D Credit Coalition, as we are as a firm, know that the R&D Credit Coalition is a group of taxpayers as well as practitioners that are very focused on claiming correctly the R&D credit from that perspective. There's over 1,000 members. We are the only CPA firm that sits on the leadership team. There's 9 of us. I sit on the team from a leadership perspective, and so we have leadership members such as Apple, Microsoft, Intel, Boeing, Raytheon, some very heavy users, if you will, of the R&D credit. So when we think about Section 174, for those of you who may and hope you attended the first session, you know that really, Section 174 came in the Internal Revenue Code in 1954, basically saying that it allowed a business and a deduction attributable to research and experimentation deductions. It's interesting that the credit, for those of you who are familiar with it, you recognize that the credit didn't come in the statute until 1981, specifically underneath the Economic Recovery Tax Act. So I give you that background for the following reason. And why it's so important and why we as a firm, as well as others, are focused on Section 174. So in 1981, when Section 41 came in the statute, it was the first throughout either the G20 or really on a global basis that there was an R&D credit. So the United States, once again, first established the R&D credit. Since that time, most G20 countries who we compete with on a global basis, as well as others, have adopted the credit. And in fact, what's happened in 2018, as an example, the US spent about $607 billion on research and development expenses, with China coming in second at about $465 million. And then in 2019, that gap actually closed from about $657 billion in the US down to about $525 billion, or up $525 billion from China. So as you can imagine, as Dan outlined, if you are no longer allowed to immediately deduct your research and development expenses, and you must capitalize and amortize them, that puts us at a significant disadvantage. This came through the Tax Cuts Jobs Act of 2017 as not really a rationale, but really a revenue raiser to allow the Tax Cuts Jobs Act of 2017 to be passed. So where do we stand, and what's the state of play? One, from the leadership team perspective that I sit on, as well as the coalition as a whole. So as highlighted in the slides, there is a lot of bipartisanship support to ultimately really repeal what's currently in the Internal Revenue Code around capitalization. In fact, in Build Back Better, if that had passed ultimately in the Senate, it would have been repealed, and it was actually repealed in what the House passed. But currently, working with members across the aisles, which is what the R&D Credit Coalition and the leadership team do, we have 36 Senate co-sponsors of the legislation and 106 House of Representative members. We are very focused on some key senators, Senator Sinema and Senator Manchin. We actually have a meeting with Senator Manchin coming up in a couple of weeks to gather his support from a Democratic side on the Senate. The reality of where we are is that this is a significant reduction in the incentive. And it is very concerning because there's an estimate that this could cost the United States, as we compete with foreign countries around innovation and research and experimentation, could cost us upwards of $10 billion a year, just from the standpoint of where we stand versus where other countries stand. Cautiously optimistic, to what Dan commented, is that it will be repealed. And then we'll talk later in the presentation of what are the avenues or the vehicles that it's likely to be repealed in. And we'll talk later about that. So that brings us to our polling question number 2. What did the IRS and Chief Counsel release with respect to the R&D credit refund claims? And you can see the answers, and we'll allow you to select your answer for the poll. And then I will hand it back to Dan, who will walk us through the GCM and where it really kind of stands. We're closing the poll, and Dan, I'll let you cover the poll results and then move into the deeper discussion.
Thank you. Appreciate it. We have a well-educated group. Well, yeah, vast majority saying all the above. We'll get into those materials on this next slide. And thanks everyone for responding to those questions, getting your CPE. And again, thanks Ron for talking about the R&D Credit Coalition. And we feel very appreciative of being invited to that. It's a prestigious group of companies and accounting firms that are participating in that. So thanks again, Ron, for that summary. The next item we wanted to cover, and if you had a chance to listen to session 1 with the IRS, with Paul and Cheryl, as well as Alex, We talked about, both groups talked about this a bit, but we wanted to share our perspective about this disclosure. From our perspective, and just to revisit at the bottom, the items that are required, all business components in connection with the taxpayer have to be addressed. The total qualified employee wage expense, the supply expense, and the total qualified contract research expenditures. And the bottom line, and one of the key things to consider, and Marty made mention of this in that last session, is that while some taxpayers may not have all the tools in place, that's part of what we do. And we believe that, we have an effective tool, a time survey that does help us aggregate and gather all this information that we need to effectively answer this question. Because as Alex pointed out as well, you do see these same questions bleed over beyond just those refunding or requesting refunds.
And Dan, let me just add one point as well,
Yeah.
if you don't mind. There's a lot of talk out there about how this may be an onerous thing requested by the IRS or additional documentation. Honestly, from the practitioner's standpoint, I view this as a chance to shine in front of the IRS. It's fairly, if you did a good R&D study, there's no reason you shouldn't be able to put a nice summary on the top of this, addressing these disclosure requirements that I think is going to just have this be well received by the IRS. It's their requirement, and I don't find it anything other than giving a taxpayer really the opportunity to shine in comparison to other taxpayers. So that's our approach on it, and that's our thought on it. And I'll leave it at that.
Yeah, thanks, Marty. I do believe, we in the process of performing audits look at other firms' work, and we do sometimes see surveys that don't necessarily do this. So I do think as you look at this slide, this guidance, and you look at how you currently gather this information, do make sure that you're gathering a way that lets you look at individuals' time by component, by business component, by activity. So we included this slide as well because a lot of our clients are pass-throughs. And so, how does this disclosure and how do you administratively address this as a pass-through? So the key thing that we wanted to articulate here, and you have all the forms to refer back to, excuse me, but if you're a partnership, you disclose it on the partnership return. And if you're a flow-through non-partnership, the individual has to disclose it on the individual return. And a key also, when e-filing an amended return, disclosure is still required. Marty, anything else on that slide from your perspective?
No, I think just the concept here is that the research credit is calculated almost at the entity level for a pass-through, but then the credits actually flow to either the shareholders or the partners. And so, in the BBA context, it's almost as if the partnership is being treated more as an entity for tax purposes, at least tax review purposes. So the disclosure is made at the entity level to the extent there is an entity there. Yeah, we'll leave it at that.
So the next slides are dedicated to a couple of recent court cases. The first one being Sandy Cole. If you had a chance to tune into session one, this one was discussed a little bit. This case is a little bit wonky and gets into some esoteric rules around the R&D credit. A lot of people are familiar with the substantially all rule that relates to wages, but there's also a substantially all rule that relates to your business component. And that is a key component of what this case was hinged upon, and also what costs are part of your process of experimentation. I won't go through all of those. They're there on the third bullet down, all the items that make up your process of experimentation for you to refer back to. But again, substantially all or 80% or greater have to be in the numerator, the denominator being the total cost spent on the business component. So continuation on this particular case, from our perspective, the IRS concluded that many of the costs are QRE that do not go into the numerator, and this is different from a similar court case, Trinity. So this case is currently being appealed, and I think we're all hopeful that some of these decisions are clarified, because from our perspective, a lot of these costs are material in those that create pilot models, and you have to incur them to eliminate your process of experimentation. These are some of, personally, my favorite projects, most interesting when you're building out pilot models to test and evaluate, and those are significant costs that have to be incurred. That's been made clear in prior IRS guidance. So we, again, hope that this is clarified and included in the numerator.
And Dan, I'll make one comment here. Every time I see one of these type of research credit cases head into litigation, invariably it begins with a taxpayer that didn't have the greatest presentation in the first place. They didn't do an ideal, what we would say, research credit study, or potentially even a basic one. And so a lot of this could have been avoided often had the information been organized and not taken to the point where it's litigated like on the back end. I think a lot of this, and again, our approach is to identify business components, identify methodology, document what four-part test is. So with respect to that, I think from a litigation perspective, you can minimize your risk by just doing your homework up front.
Thanks. Let's move on to the next case, Leon Max, and this really builds off of Marty's prior comment, and probably even more so. This is a case where the technical uncertainty and process of experimentation weren't that well framed out, and a lot of the costs seem more akin to quality control. So the outcome perhaps wasn't surprising. What was favorable for the people in this industry, the garment industry, is that the IRS indicated and concluded that you can have qualifying R&D costs in this industry. Just the particular facts for this taxpayer didn't line up well, or weren't documented well during the course of the study. Some of the particular areas that were qualified are areas that are specifically disqualified, and so it made it, I think, a case that was pretty easy to shoot down a lot of the cost, unfortunately. So with that, I'll turn it over back to Marty to talk a little bit about ERC. Thank you, and appreciate it.
All right, Dan, thanks a lot. So the employee retention credit, clearly one of the most talked about and sought after credits that we have been working with a number of clients on. And I just wanted to share this with our audience. And I feel good about it due to the fact that this is the information being requested if an ERC claim is examined. They want the originally filed 941s. They want to go back to the original payroll information, basically your work papers, detail on the employees, making sure that there's a carve out for other credits like the FFCRA, COVID sick leave pay. Most importantly here though, documentation to show how the eligible employer status was determined. And from my perspective, there's two ways to qualify for the employee retention credit. One, you show a significant decline in your gross receipts. So you're going to need to show your quarterly gross receipts in the context of how you report them for tax purposes. That's easy to show if you have the records, and that's a slam dunk. Then to the extent you have either a respective 50 or more than 50 or more than 20% decline in the 2020 or the 2021 credits respectively. Or more importantly, if you are an eligible employer due to COVID-19 mandates directly affecting you, causing a partial shutdown specific to travel, commerce, and group meetings, those mandates, in our opinion, need to be identified and linked to the story of how they affected the employer and for the time period that they affected the employer. We see a number of other organizations out there indicating that almost all employees qualify for this thing. All employers qualify for the employee retention credit. Many employers qualify for the employee retention credit legitimately. But just our advice here is, and this follows the way that we document these, when we get to the government order test, be wary of not documenting how a specific government order is actually affecting the business and causing the partial shutdown. And that's really been our specialty and our focus. And after I saw this come out, It just made me feel great about our deliverables and our approach. So I will leave that at that for ERC. Yes, and these are more of the questions, and so I think I covered all of this already, but we'll move on. Take it away, Ron.
All right, thank you, Marty. So let's talk about the clean energy tax proposals. We wanted to update you on this because as I commented around 174 and where we saw bipartisanship support as evidenced by some of the past legislation in regards to Build Back Better, as well as the pending legislation, which we'll talk about in a few moments. What is clear in our country is that we need to enhance, beyond the infrastructure bill that was passed last year, our alternative energy. So when we talk about clean energy tax proposals, we as a team do a significant amount of work based on the provisions that are in the statute currently, but we want to talk about, so to speak, where the proposals are coming and will likely end up prior to year end. So we know that Congress had hearings early 21. Because clearly underneath President Biden, this is a high priority in his administration. We further saw that in what is referred to as the Green Book, which is in essence the president's budget. As you all know, we have a September 20 year end, so he has put forth the Green Book. That has not actually gone forward, but what he did do in the Green Book was he took the provisions which were in the Build Back Better. And as a reminder, Build Back Better passed in the House and then, of course, stalled in the December timetable of last year in the Senate, predominantly due to two senators being Senator Sinema and Senator Manchin, who are supportive, by the way, of the repeal of 174. Continuing that bipartisanship. We saw, as I mentioned here in November 2021, it was not passed by the Senate. Again, a continuing furtherance of let's enhance as well as expand all of the alternative energy or what are referred to as clean energy provisions. Senator Wyden, who chairs the Senate Finance Committee. As we know, House Ways and Means and Senate Finance Committee are the two key committees that we watch in the House and the Senate when we talk about tax legislation. In December of 21, released just another bill that was solely devoted to clean energy as he saw Build Back Better potentially not being able to be passed out of the Senate. So bottom line is a tremendous amount of momentum for a package in 2022. And candidly, Congress has, as I mentioned, underneath what's called really kind of the reconciliation provisions prior to September 30 to get that accomplished from that standpoint. That is above and beyond what's also occurring in what's referred to as the America Competes Act that I'll talk about. So what are some of the things that are going to happen in these clean energy tax provisions? I think that's important to highlight. So you see a significant amount of what are referred to as elections for direct payments of the credit amount. In essence, a significant number of the credits will be deemed to be refundable credits. There is an enhancement of what some of you may be familiar with in regards to the 1603 grant programs around a grant from the federal government towards alternative energy. And then both of these, because we are active in this space, are going to impact what we call the energy equity markets. So when you get into a structure such as a flip strategy in a solar scenario or a inverted lease in a solar scenario, solar being the one I'm using here because most people are familiar with that, but those techniques are also available for other alternative energy, geothermal, hydroelectric. There is going to be a super bonus credit, as they refer to it, if you meet certain wage and apprenticeship requirements. So this is part of not only Build Back Better, but also part of what's referred to as the Green Book. But it is also one of the areas that in the American Competes Act that we'll talk about that is a strong focus. So whenever you think about tax legislation from a policy perspective or from what's the likelihood of something being passed, certainly in the environment we live in today, we always look for bipartisanship support because that will tell us that there's some form of an agreement that could ultimately be reached. The other bonus credit, so when you think about what I refer to as stack and rack credits, you get a bonus credit if you meet wage and apprenticeship requirements, and then your credit is enhanced even above the statutory credit to the extent that you are using what are referred to as domestic production assets. So when we think about steel and iron, things like that. So here are some of the things that we just wanted to highlight quickly. So when you think about alternative energy or clean energy, green, think about it in that there's basically two categories that we're dealing with. We're dealing with production tax credits to incent the taxpayer to build a facility and therefore generate, let's say kilowatt hours. So you get a production tax credit. So there's a number of provisions that are going to extend when my project has to begin construction. And that will be ultimately extended to January 1 of 2027. Very important because there is still construction occurring in this space, but not eligible for what's referred to as the production tax credit. You see this in wind and solar and really anything that's what is referred to as a electrical renewable credit. Section 48 of the statute, as opposed to Section 45 being kind of the production tax credit side, again, falls into two pillars, is what's referred to as the investment tax credit. This is going to cause really a very significant incentive to continue to build solar farms, geothermal, hydroelectric, wind production, et cetera. So there's what's often referred to as the investment tax credit, extension of the credit. So again, the timing is very important because of what's happened in the statute. So this is going to be basically for projects placed in service for January 1 of 22, but that is likely to move. Now, underneath prior legislation, we saw a reduction in these credits. So for example, the 30% credit for solar now sits at 26% and is ultimately to be phased down into 22. So we see in the clean energy tax proposals, basically a reinstatement retroactively back to the 30% credit, whether we're dealing with solar or geothermal or fuel cell, small wind production, microturbines, all the things that we as a team get involved in, but a very strong focus on creation of jobs, specifically when we think about a super credit when you are in a wage and an apprenticeship program. And then if you're building that with those assets that are more domestic oriented, another credit, a stack and rack credit. On the right-hand side are all of the credits that, so to speak, are new. So when you think about the clean electricity production tax credit, or the investment tax credit, this carbon sequestration credit, all of these credits are expanding the clean energy, which is certainly whether it was under, again, Build Back Better, the Green Book of the President's budget, and or where we see bipartisanship support underneath Senator Wyden. And I would tell you that Senator Manchin has recently, and we'll talk about negotiations about a mini Build Back Better, has also put forth that this is a very high priority for the country. I think I can point to simply the gas prices that everyone is feeling, obviously on front pages and front news. And so when you go to fill up your tank, it's very, very expensive. So let's go to the next slide, and I want to talk about the direct pay election, because this is a significant change when you think about the wind or the production tax credit or the investment tax credit, and then the expansion of all this. So on the left-hand side, as well as on the right-hand side, is all of the areas that you could, as a taxpayer, subject to the legislation, in essence, elect to go ahead and treat that credit as an estimated remittance. So underneath the direct pay scenario, as it's referred to in the statute, the taxpayer treats the credit generated by the relevant projects as an equivalent to a payment of tax on the taxpayer's return. And in some instances, it's actually a refundable credit where the government will fund prior to you filing the return. You do make a direct payment election, and it is a one-time election. So when you think about alternative energy and green energy know that there are a significant number of provisions that are currently being considered, and we'll talk more about the American Competes Act. So that brings us to polling question number 3. With respect to the past bipartisan infrastructure legislation, which was passed in November of last year, what is the funding amount and the mechanism of that deployment of capital? So we'll give it a little bit more time because we want to make sure we are able to get through the legislative side and the bipartisan infrastructure bill. All right, I think we've got a good head count there. So let's share those results. 20% indicated none of the above, and that is actually the correct answer. So the point of the next discussion is there's a lot of confusion around the November 15th passed bipartisanship infrastructure bill. So remember that this is the bill to really kind of rebuild our infrastructure in regards to the country. So it really has a number of programs, and it's at 1.2 trillion. Now, as you'll see in the next slide, the 1.2 trillion is actually divided into 2 pillars of what I refer to as capital. Now, granted, the federal government passed the legislation, but ultimately to the polling question, there are formulas whereby states are allocated the 1.2 trillion depending on which pillar of capital. So there's a pillar of $550 billion, which often referred to as new infrastructure. And then there's a pillar that was an allocation from the CARES Act, which of unspent funds of $750 billion. But here is the infrastructure in the country that is going to be impacted based on the bill. And it is now being referred to as the bill bipartisanship infrastructure bill. Technically, that's not really the name of the bill. So let's go to the new side, because that's where the first flow of funds are coming from. And the first flow of funds are not being deployed until really the fourth quarter of this year. And $58 billion will be deployed to the state levels through the first tier of allocation, which is formula driven across the 9 federal agencies that ultimately control, if you will, the allocation of the funds. So the federal government certainly is going to indicate to states if it's a federal highway or if it's a state highway where they want funds deployed, but ultimately the states control, and then the states ultimately allocate down into the counties. So most people recognize that roads, bridges, and major projects are really the focus of the infrastructure bill. But again, there's ultimately 12 programs that of the 1.2 trillion. What I'm showing you here is just what is referred to as the new project funding. So this is in reference to really creation of new infrastructure in the country. Roads, bridges, as you may recall, when President Biden was actually talking about the bill, unfortunately, a bridge collapsed the same day he was actually in one of the cities. And so that kind of caused a lot of why we need this infrastructure bill. You can see that there's a lot in regards to passenger and freight rail, and then there's a lot in the airport area. And then flip to the next slide, you can run through all the 550 billion to the next slide. So there's a lot in there. Notice item number 7, $73 billion is above and beyond what I just talked about in clean energy that is likely to pass. Cautiously optimistic, bipartisanship support. But $73 billion will be deployed in investing in clean energy transmission and grids, building miles of what is referred to as new resilient transmission lines. So there's significant dollars that are coming. Now, I mentioned $58 billion. If you looked at the bill and you saw how it was scored, and then you looked at how the deployment of the capital would be over the next 5 to 10 years, the estimate was $58 billion that would be deployed in the fourth quarter of 2022. That estimate actually has now increased, specifically given some of the things that are going on in our economy. We don't have time to kind of talk about that. But notice the next large sum when you think about high-speed internet broadband as well is about 65 billion. So when you think about industries that are going to be impacted, I know we have a lot that are attending today from what we call recon or real estate and construction. So I wanted to highlight in a slide what you need to pay attention to if by chance you're a real estate developer or you're a construction entity, and what that means to you in regards to these projects. And so again, the federal government has 3 tiers of the allocations of the capital, but when you think about industries that are going to be heavily impacted, I start with recon around the real estate development and opportunities that ultimately are going to align closely with the infrastructure bill. Broadband, we talked about transportation systems and utilities. That's going to drive many real estate asset projects, classes, and really just change the economy as we know it. And there's also an element of demographic allocation in this bill as well. Obviously, you can't do anything if you don't build it. So that's where it's going to impact the construction. When we think about industrial, which is another industry that's going to be heavily impacted, industrial manufacturers must, given the supply chain breakage, elasticity, must ultimately continue to prioritize and evolve health and safety measures. It's tied actually back into a number of the clean energy provisions. So ultimately, digital automation, the digital revolution, as it's often referred to, or the technology evolution, is going to impact all businesses. But when you think about the infrastructure and broadband, this is going to be a very significant opportunity for, quote, manufacturers to take advantage of when you begin to read the 2,700 pages of the bill. So let's move on in the spirit of time to our polling question number 4. So with respect to pending tax legislation, what is the number of bills currently pending that could be passed currently either in the House, the Senate, or both? All right, I'll give it a little bit more time. All right, so 52% of you all indicated the correct answer, greater than 10. The actual count of pieces of legislation that have been introduced that are either in committee, have come out of committee, that sit in the House or sit in the Senate is upwards of 25 plus different pieces of legislation. And so Congress is alive and well. And that brings us to where we want to talk about what should we expect in the next weeks? What should we expect in the next months, specifically that are going to impact, obviously, the tax credits and incentives or drive the behavior that Congress wants with respect to the different types of credits and incentives. So Congress is back in session, as we know. They have a lot on their agenda, but the bottom line is, whether you're a Republican, an independent, or a Democrat, the next 2 months are very crucial to this country, as predominantly the dominant party in the Senate and the House, obviously attempt to pass something, and I refer to something because I'll tell you the vehicles that are being focused on right now, before the August recess and before they hit the campaign trail before the midterm elections. So I'm going to try and highlight to you where we need to pay attention. So some of you, hopefully all of you, are familiar with what is referred to as ACA. That's not the Affordable Care Act. That is what is referred to as the America Competes Act of 2022. It was passed in the House in February of 22 in response to what the Senate passed back in June, which was called the U.S. Innovation and Competition Act. What this act is all about is the competition with China. So when you think about America Competes Act and you think about whether it's 174 and the mention I made that China is very close to us. And by the way, China announced just this week that they are going to adopt a super deduction around their innovation and their R&D activity to further compete with the United States in regards to R&D or R&E efforts. So when we talk about the America Competes Act, we know that it was passed, quote, in the Senate, and passed in the House. And so on March 28th of 2022, what the Senate did was they took the House piece and they went ahead and amended it and substituted language so that they got to one bill so that we could go into what is called conference, which is currently where they are. Now, it is not an unusual legislative procedure around amendments to a House bill, because technically all legislation really starts in the House. But this is where it gets interesting in the next slide to me. When you think about in the conference, the House actually rejected the amendment. And so the House are proceeding with conference committees in regards to their ACA. And this process is ultimately designed to work through, as we know, what's ultimately called joint committee, where you try and get conferees in place. The two bills seem very straightforward around we must do something as a country beyond Build Back Better, which is more of a domestic program. But these are all American Competes Acts are really about the semiconductor industry, as well as the recent, I guess, push and pull right now when you think about the supply chain. So ultimately what happens is the House gives a little, hopefully the Senate gives a little, and each body votes on a compromise, and then we have a piece of legislation that goes to the president's desk. So you would think that conferees would be a relatively small group. Now, I will tell you that both the Senate and the House gave conferee instructions around ACA and highlighted 174. So we talked about that earlier. So both the House and the Senate, showing bipartisanship support, said within the American Competes Act, which really deals with supply chain, semiconductor, other things, we want to make sure that you are addressing 174. Now, this is the piece of legislation that was originally, as you'll see, expected to be, quote, reconciled and ultimately passed in both chambers and gone to the president before the July 4th holiday. That is unlikely to occur. But kind of trying to be clever here, so seeking to surpass what I call the Brian Setzer Orchestra or the P-Funk All-Stars, there are 107 conferees attributable to the American Competes Act. That candidly is unheard of. So when you think about giving every politician who's a conferee, who's in the reconciliation, and an opportunity to speak out, it is likely that this is going to be more of an August type timetable. But the American Competes Act has the greatest amount of bipartisanship support. So again, what is it to do? It's to support the supply chain resiliency and improve our nation's economy in regards to preventing the shortage of critical goods. So obviously COVID taught us that the supply chain around the pharmaceuticals was in trouble, if you think more domestically, if you will. So the bill contains incentives of upwards of $50 billion to invest in facilities for the fabrication, assembly, testing, and advanced packaging of semiconductors, and which ripple through the economy overall. We know that numerous industries got hard hit, which we often refer to as the supply chain breakage or the elasticity. But the bottom line is this is the vehicle right now that is the furthest along, is likely the vehicle that we will see potentially other tax provisions attached to, and I'll speak about that. Some of those provisions ultimately are going to be what? One, clean energy, where we have bipartisanship support. Two, 174, where there is clearly bipartisanship support. And then third, I'll talk a little bit about other areas where there's bipartisanship support. So here's a statement from the president, just to give you a sense of how this is kind of a rallying point. So President Biden indicated, together we have an opportunity to show China and the rest of the world that the 21st century will be our century from an American perspective. And I don't think he's wrong in that statement. In fact, I would tell you that there is no one, and being part of or being on the leadership team of the R&D Credit Coalition, every senator I speak to, or representative I speak to, or independent I speak to, no one has said they do not support the American Competes Act, which means ultimately passage is likely. So this is my statement. It was originally scheduled to be before the July 4th recess, but more realistic, it'll be prior to the August recess before they return. This has a lot of momentum. And as you can see here, there are actually meetings today with respect to meetings behind closed doors, if you will, in regards to the version. So I know that earlier in the week, for example, there was a meeting between Speaker Pelosi, Senator Schumer, and Senator Manchin around the American Competes Act, and specifically some of the discussions around the tax, which we'll talk about in mini Build Back Better. So again, there's some proposed tax changes that would include, and this has great support, a 25% tax credit for investments in manufacturing facilities or related equipment, attributable. And then of course, the return of the 100% R&D. So let's go to the second piece. That's what's happening in the coming weeks. What I'll tell you is coming in the months is beyond that. I mentioned it earlier. So we are a September 30 year end as a government. So there's a reconciliation process that is going on behind closed doors. There was a chance that it would merge before the Memorial Day. In essence, the budget reconciliation bill to replace Build Back Better. It's often referred to now, if you read the paper, mini BBB. This is, again, the meetings that are occurring. And by the way, Senator McConnell has been in these meetings as well. So it is being discussed. It must occur prior to September, but it is unlikely that this is where we're going to see, from a tax legislative perspective, really any type of tax increases. So there's been consideration of obviously raising the 21 to 28. There's clearly bipartisanship support in energy and climate provisions. And of course, there ultimately has to be prescription drug reform. So I can only tell you that the Democrats are very focused on mini BBB, but what the vehicle is that they're going to be able to attach tax legislation because there is not support across the aisles. There's not bipartisanship support in regards to a mini Build Back Better from that standpoint, which could create all types of problems if you tried to force it through the Senate. So again, deadline September 30th. There's been new developments and focus just like last week around the reconciliation package. So there's going to be some Affordable Care Act premiums that are being played in there, and then some items on the American Rescue Plan as well. So let's keep going. So what I wanted to do here is just what's happening. You might have read some of these things. So this is what's referred to as the Rise and Shine Act. This is all about securing a strong retirement. There was an article in the Wall Street Journal this morning that indicated if you look across our country, unfortunately, across the country, when you think about retirement, individuals have less than $100,000 in either their 401k or the IRA. So this is going to be what's called the Secure Act. Secure 2.0 is how it's referred to. I call it the Rise and Shine Act, which is the technical name. The House passed it in March, and it includes provisions, as I've highlighted here for you. So let's talk about some areas that are strong focuses, and Marty talked about ERC. We certainly don't have any concerns. Paycheck Protection Program. This came underneath the CARES Act. The sad part is that the government estimates that the fraud in the Paycheck Protection Program has now exceeded $100 billion. So there is a piece of legislation that is likely to pass addressing what's called PPP fraud in the Small Business Administration. Basically, it would give prosecutors up to 10 years to pursue civil and criminal charges. Late breaking last week, next slide, was a Congressional Appropriations Committee came out and said, we want to fund the Internal Revenue Service by giving them another $1 billion of funding. Again, this is all potential. We know that the Internal Revenue Service, no disrespect, is undermanned and under-resourced. You can read the articles in regards to, obviously, even Cheryl commented, how long it takes to get an answer from the IRS. So this is likely to take some legs. Commissioner Reddick is certainly on this. So I would expect that somewhere in ACA, you're going to see some funding, but it's probably likely to come under reconciliation. This is an interesting item. So the dirty dozen. So the IRS issues This came out June 28th specifically. So, kind of breaking. The IRS always highlights the areas that they have the strongest concern. The R&D credit had been on the dirty dozen list candidly for years. It dropped off this year because what we're seeing is more international abuse type transactions, specifically in the Maltese individual retirement arrangement, as well as in foreign captors. So, just pay attention to that. It's just late breaking. SPAC update. This is interesting for those of you who are familiar with special purpose acquisition corporations. So it was the rage in 2021. So if you were to look at SPACs, as they're referred to, or special purpose acquisition corporations that were created, which ultimately take a company public, in 20, there were 248 transactions or SPACs completed at a volume of about 83 billion. In 2021, we saw that number grow to 613 SPACs that went public at $160 billion. You also probably have read that, all of those public companies of SPACs type lost values of upwards of 40 or 50%. So Senator Warren has introduced, and it has legs from the SEC, to basically have a SPAC Accountability Act of 2022. And then this is where I'll end our presentation in the spirit of time, because we could talk for hours about potential legislation up there to my comment of greater than 25 bills. Make a long story short, there are some real challenges in how do I account for cryptocurrency and digital assets, CFTCs, and what is the structure for taxation of digital assets? It's not outlined statutorily. And so Senator Gillibrand and Loomis released what's called the Responsible Financial Innovation Act last week, which ultimately would create some clear definitions. So on behalf of Marty, Dan, we hope this has been informative for you. I would tell you to pay attention to the American Competes Act. That is where everyone is focused, and that is likely where we will see some of the clean energy or green energy provisions, as well as Section 174, because the conferees, all 107 of them, were instructed that piece of legislation needs to be in the bill. A lot out there, but we hope we've at least kind of given you some guidelines of what's forthcoming in the weeks and months.
And just in conclusion, I think everyone should feel optimistic, because if Ron Wainwright can reference George Clinton and the P-Funk All-Stars in the context of congressional bipartisan negotiations, we should feel very optimistic as a country. So thank you all for joining. We value your feedback. Our next webinar starts in 20 minutes, Hot Topics in Cost Seg and Energy Studies. We look forward to you. Thank you, Ron. Thank you, Dan. Thanks, everybody.
Thanks, everyone. Appreciate it.
Thank you.